We all know Realty Income has been taking a hit this year in comparison to the rest of the stock market. Well, most REITs have been taking a hit, not just Realty Income, but today we are talking about Realty Income. And yes, this is an overall market issue, not just Realty Income, but why are they being hurt more than some of the other stocks? But first, if you're new here, my name is John and this is Talk Finance.
I'm not leaving. I'm not leaving. I'm not fucking leaving! The show goes on! This is my home! They're gonna need a fucking wrecking ball to take me out of here! They're gonna need to send in the National Guard or fucking SWAT team, because I ain't going nowhere!
And I will answer your comments as best as I can, so feel free to comment away with questions or information that you feel is important. Okay, so let's start with something rather new, but everyone has already heard about at this point. Realty Income investing in the casino business. More specifically, Realty Income buying a minority ownership stake in the Bellagio and entering into a partnership with Blackstone Real Estate Income Trust. This is not Realty Income's first purchase into the gaming industry. As you may recall, they purchased Wynn Encore Boston Harbor Resort and Casino back in 2022 for $1.7 billion at a 5.9% cash cap rate. But this recent purchase of a 29% stake in the Bellagio is their entrance into a larger gaming industry. What is the Bellagio, you might ask? Well, it's not just any casino in the Las Vegas Strip, but one of the best casinos in Las Vegas.
The Bellagio Hotel is one of the 2 certified 5-diamond hotels in Las Vegas. When you enter the Bellagio Las Vegas, you are completely submerged in the grandeur and beauty of the structure. When you first enter, you experience a splash of natural light from the massive ceiling skylight. There are massive glass structures, elegance in every aspect of the Bellagio Las Vegas Hotel. Each room in the Bellagio Hotel is designed to show off comfortable elegance. With 3,000 suites, you will be able to select the type of room that you want. There are many activities and attractions at the Bellagio Hotel that outshine many of the ones available at other nearby Las Vegas hotels. Ranging from spectacular fountains to unique shows, you can find an activity that can suit those of all ages.
It is constantly appearing in the top 5 best casinos in Las Vegas. By the way, Vegas has over 63 full casinos, so to be in the top 5 in almost all the reviews and rating websites definitely shows there's a preference of where people choose to spend their money. Okay, so why am I so focused in this one area of their recent business? Well, most experts are saying that one of the reasons for a huge price drop in share price is because of Realty Income's new investment in the Bellagio. They see it as out of the norm for Realty Income, which is known for safe, calculated investments in economically sound businesses, or let's just say recession-proof businesses. Another obvious reason is that back in August, Realty Income filed an agreement to sell up to 120 million of its shares. That amount of shares being sold will hit any company's share price. But here's the kicker. This is nothing new for Realty Income, or most REITs for that matter, since REITs have to distribute 90% of their taxable earnings to existing shareholders. Therefore, they have to do one of 2 things. Either take out a loan, which most REITs don't want to do with current interest rates available to them, or sell more shares to finance more property purchases. I will say though, Realty Income does sell their shares more often and in a larger quantity than most other similar REITs. They also have been heavily offering more shares the past 3 years than most REITs would. Another big reason the share price took a hit, to put it simply, is because there's other opportunities out there that people seem to like more right now, such as high yield savings accounts, growth stocks, or even value stocks that they feel they will get a better return in versus Realty Income's current dividend yield of 6%. I do want to let everyone know at this point that I do hold shares of Realty Income. And before this price drop, I wasn't sure if I would keep buying more shares of Realty Income even as the price went down. I felt it was already a bit overvalued compared to other investment opportunities, and I was just allowing the dividends to drip and purchase more shares of Realty Income. But when the prices went below my cost basis of $50 to $55 a share, I just had to buy more shares and keep bringing my cost basis closer to the $48 to $50 a share. Long-term investors and dividend investors look for similar things in the companies they invest and stocks they purchase, but everyone has their own game plan. Some dividend investors don't really care what a stock price does, since they are only looking for the dividend payment, but I do. I don't want my share price to drop as I get paid out a dividend. If the share price doesn't do much year after year or has a slow growth, that's fine with me in exchange for a growing dividend. But I don't understand the dividend investors that don't see an issue with a company that constantly loses share price while having a dividend that we don't know if it will be reliable in the future. If there ever is a dividend cut, or the dividend stops growing, or the company is having issues, I would like to have a chance at rebalancing my portfolio and not sell at a guaranteed loss. How about we go after an almost guaranteed win one way or another? I don't think the fundamentals have changed much. Is vertical farming and the casino business riskier investments than what they have had in the past? Yes. Are they recession proof? Well, I can tell you the casino business is definitely not recession proof. In fact, it's usually one of the first businesses affected by a recession. But it is also a business with high profit margins, and when the economy is booming, can be a huge win for Realty Income. I think their business model is the same. They diversify. They have a very diverse portfolio, and it's pretty recession proof. But to keep providing their shareholders with the growing reliable dividends it's known for, it has to increase its revenue substantially. Realty Income is no longer in the business of buying a building or two at a time, but buying into an industry. Also, can I just say something? We won't really know if this is a good investment until a few years down the road, when they're seeing those profits roll in. It all depends on the economy. If it stays strong, we will see it sooner. If it does not, they will have to recoup some of those losses in the long run. And another thing, you can't own Vici and hate on Realty Income's decision to join the casino business. If anything, you should love it because they are entering a business model you already owned. But Realty Income seems like the safer choice to me, since they have multiple industries they are part of and therefore can rely on different industries to keep the company's share price and dividend payments stable. Let's look at the most recent stats on their website, which data shows it was released on June 30th of this year. They have 99% portfolio occupancy rate, which is impressive by the number of properties they own, which currently sits at over 13,100 commercial properties under long-term net lease agreements. Those properties are divided amongst 1,300 different clients in 85 different industries. Like I said, diversified. If we look at the map, we can see most of the concentration of properties is in the United States, with some properties in Europe. Specifically, they have a large quantity of properties in the UK. In fact, their top region that brings in the highest total portfolio annualized contractual rent is in the UK, followed by Texas, which is right behind them, and after that we see California, Florida, Illinois, Massachusetts, and Ohio. The chart shows us that retail is the largest percentage of the total portfolio annualized contractual rent, followed by industrial, and gaming sits at just 2.7%. So if something were to happen with the Bellagio, we would notice, but it wouldn't affect Realty Income in the long run. And if we stay positive and realize the amount of growth the gaming industry could bring to Realty Income, we can see that the benefit would outweigh the cost in the long run as well. Realty Income's share price currently sits at $50.95. Year to date, they're down 20.14%. This past month, they're down 7.62%. But the past 5 days, we are seeing some price stability with an increase of 2.74%. I do think because of some external factors, the stock will dip a bit more before it continues its recovery. But don't expect a straight shot up. Just like it did in 2020, it did end up recovering its share price, but it was at a slow pace. We have also seen an increase in analysts saying that it's time to buy, with 8 analysts saying buy and 10 analysts telling you to hold. That is a change from yesterday when we had 9 analysts saying buy and 9 hold, but an increase from 3 months ago. Also, this is one of those examples I feel like is very important to notice, where I'm sure you've heard the quote, be greedy when others are fearful and be fearful when others are greedy. I feel like this is another example of a company which fundamentals still remain strong, and people are fleeing to other stocks they feel would be stronger, or maybe other safe havens, high yield dividend stocks, or whatever else they might encounter out there. And in this case, I do feel like this is an opportunity that presents itself. Not a huge return in the future. I don't feel like this company stock price is just going to skyrocket. I do think it will come back up to a fair price of around $55, maybe around early 2024, and eventually increase and go back to its price in the 60s, and eventually back in the 70s, maybe by 2025. Before you make a decision on Realty Income, you should see what some of their future plans are, such as in this article it says Realty Income REIT making moves into European net leasing. Not sure if you're aware, but net lease properties in Europe are not as common as they are in the US, and Realty Income is trying to be the primary owner of these kind of properties in Europe. By the way, most of Realty Income properties are triple net leases, but a net lease is where the tenant pays for all the costs related to a piece of property as if the tenant were the actual owner. The tenant pays for the real estate taxes, the building insurance, and maintenance. These expenses are in addition to the cost of rent and utilities. The article states that the move into Europe began in 2019 when Realty Income acquired a large tranche of grocery stores in England. Now, the REIT is looking to Europe for even more opportunities. The reason for the move is twofold. First, a REIT the size of Realty Income, which has 13,000 assets plus, can't buy one or two properties at a time and see a noticeable increase in investor return. Second, in addition to having an abundance of available assets, the European commercial market is not dominated by net leasing. What this means for Realty Income is that there is a tremendous profit potential in acquiring European assets and converting them to net leases. The profit potential is even higher because of the lack of competition for assets in comparison to the US, where multiple net lease REITs are always looking for new acquisitions.
Wow.
Just like with any investment, there are risks, and Realty Income is not adverse to risk, especially as they grow larger. There are so many obvious opportunities out there when it comes to where to put your money, such as high-yield savings accounts, bonds, CDs, growth, or value stocks, which I will say I'm investing in some of those as well. But even with the risk, I chose to buy Realty Income because they are at a 52-week low. They have taken more risks to grow the company, but I don't think the fundamentals of the company have changed. And if anything, they have become more diversified. I do think the share price will recover like it has before and continue to grow. I don't think I will be buying a heavy amount of shares, but will definitely dollar cost average and grow that position a bit more, since I think it presents the best opportunity for long-term returns based on other stocks which share price remains stronger or more stable at this time. What are your thoughts? Are you buying more Realty Income, or are you investing in something different? I do think you should be cautious in the current times and seek out different opportunities and make sure to have that nest egg just in case. Well, if you found this video informative, please consider giving us a thumbs up by hitting that like button and consider subscribing. See you in the next one.